Well, good morning, everybody. It's a snowy day outside, and we've got classes canceled. And I thought what I'd do is record a quick walkthrough of the content that we were going to cover in class today. We're still going to go through this in class, most likely on Thursday. Stay tuned for an email about that. But I wanted to get this in front of you, similar to the financial statements video that I sent out late last week, because on February the 5th, we're going to have our midterm exam, and a significant portion of that is going to focus on financial statements and financial statement analysis. And this particular lesson is on financial statement analysis. And again, I want to get it in front of you as soon as possible so you can learn it, so you can practice it, and be better prepared for the midterm exam. So we'll just go ahead, we'll do this walkthrough, and again, we will review this stuff in class, but I would suggest to you that the quicker you get on top of this, the better off you'll be, okay? So within what we would have normally covered, we're just going to focus on this, and specifically on financial statement ratios and overall analysis. Okay, so quantitative analysis. None of the calculations we're going to go through here are particularly difficult. In my opinion, the biggest challenge is just finding the information on financial statements that are relatively new to you. But we're going to go through that in this video. Okay, so let's just go ahead. So first of all, a little bit from the news, and this is just sort of to reflect the objective of what we're going through today. So I'll note that, and this is a little bit old now, but the company Aritzia reported third quarter results in 2025. And speaking about increases in net revenue and increases in sales growth, in overall net revenue, retail, or net revenue from e-commerce, the difference from overall retail and e-commerce, the gross profit margin, EBITDA, whatever that is, has increased almost 50%. Maybe that's good, maybe that's bad. We don't know yet. Net income has increased 71, almost 72%. That's pretty good. Um, so really, you'll see financial information like this all the time as organizations report their results. And our objective here is that by the end of this lesson, and then with a little bit of practice afterward toward the midterm, what we want to do is get a better sense of what this all means. So EBITDA, first of all, what is EBITDA? We're not even going to get to that in this course, but as you progress through your business courses, you're going to get a better sense of what this is all about. We are going to get a better sense of, for example, what gross profit margin is. We're going to look at what the difference is, what net income is, and what it means to grow year over year and as a percentage of net revenue. So all of these things. So these will be important. So that's really the objective of what it is we're going to go through today. So we're going to demonstrate the application of financial statement analysis, and that's going to include vertical and horizontal analysis, and then ratios. We're just going to do an overall introduction. We're going to talk about what solvency ratios are and what profitability ratios are. There's other ratios, but those are just the ones we're going to look at now. Bringing it all together, we'll speak a little bit about this on this video and then a little bit in class. Okay, so that's what we're going to do. Now, before you go through this video in its entirety, it would be a good idea for you to have, first of all, had a look at the document titled Financial Statement Analysis Vertical Horizontal that's presented on Moodle, and I've got it outlined here in red. This is what it looks like. And then likewise, I'd like you to have a look at the sample financial statements titled Brady Goat. Those are also on Moodle, and you see screenshots of those two here in green, okay? And that's all it is a sample. It says consolidated statement of financial position. That's what we've been referring to as the balance sheet, and a consolidated statement of income. That's just the income statement. Okay, so we want those two financial statements, and it would be a good idea to review this document, the vertical and horizontal analysis document. It's only 2 pages long, together with the ratio readings from your textbook. Okay, so that will be the best way to prepare yourself for what we're about to go through. Okay, so let's go ahead and proceed. The other thing, I forgot to mention this, the other thing you should do is download this document, okay? And really, all this is a way to capture your work. You could just write it down on a blank piece of paper, but a lot of what we're going to do here is about not just the calculation, but organizing it in a way that you're going to be able to easily report on it. So what I've done here is for vertical analysis and horizontal analysis, which you're going to read about and which we're about to review. I've listed many of the things that you would often capture. You can capture really anything with vertical and horizontal analysis, but these are some common ones. And then just sort of a year one, year two, three row or a column for each of those things. So this could be 2021, it could be 2020, 2022, 2029. Well, not 2029 yet, but then just the year after that and the year after that. And then we can also, as we'll see later on, we can also do not just sort of absolute performance for any of the things that we're going to calculate, but we can compare them. Compare. So if we had a number here, for example, well, how does it compare with our prior calculation for a prior year? How does this compare against our competitor? If we have an industry average, how does it compare against the industry average? So then we're able to calculate these things not just in and of themselves, but also compared to ourselves in prior years and how we're lining up against the competition. And it's in that way that we're able to give a relative sense of our performance. And if all this seems kind of foggy right now, don't worry, that's exactly what we're about to do. So we'll do this for vertical and horizontal analysis, but we'll also do it for our ratio analysis. So the 5 ratios that we're going to look at, the current ratio, the debt to equity ratio, and 3 profitability ratios, return on sales, return on equity, and earnings per share. We've got the formulas for these, and then again, we can capture them across multiple years, and we're going to be able to compare to ourselves in a prior year, and then to the competitor, the industry, and where it exists, what's referred to sometimes as a generally accepted standard or a rule of thumb, okay? Generally accepted standard or a rule of thumb. And that just gives us, again, a relative sense of how we're performing, okay? So again, I would encourage you to capture these 2 little sheets and then to have reviewed these things before we begin what we're about to do, okay? So we'll jump right in. Let's talk first about vertical and horizontal analysis, okay? So vertical analysis is it's a common practice to convert the dollar amounts in the income statement, for example, and you can also do this in the balance sheet, into percentages, letting either sales, in the case of the income statement, or total, that should read total assets, excuse me, total assets as 100%. And then any other line item on the income statement would be measured relative to sales. So if we were looking at, for example, cost of goods sold, we would just divide that line item by sales and then multiply it by 100 and express it as a percentage. We're going to look at all this. Likewise, on the balance sheet, we would look at any other line item, like maybe, for example, current assets. We would divide that by our total assets, multiply by 100, and express as a percentage. Okay? So really what this gives us is a sense of relativity on, for example, our income statement. This would also be true of our balance sheet. So if I was to ask you, for example, is $1,000,000 profit, is it good? Well, I mean, if you found $1,000,000 on the ground, you'd probably pick it up. So from that sense, $1,000,000 profit is good. It's better than $1,000,000 loss. But it's worth considering what organization would be more efficient at generating profit. A company that had earned $1,000,000 on $10,000,000 sales, or a company that had earned $1,000,000 profit on $1,000,000,000 sales. Well, it doesn't take calculation to know that the company that had $10,000,000 sales and was still able to generate $1,000,000 in profit would be more efficient at generating that profit than the company that generated $1,000,000 from $1,000,000,000 sales. Okay? So that's a lot of what vertical analysis gives us. Horizontal analysis is able to give us percentage increases or decreases over time. So if, for example, we had $10,000,000 sales, well, maybe that's good. And maybe it's good if we have generated $1,000,000 profit. And if we looked at that $10,000,000 sales, and in the prior year we had $20,000,000 sales, well, our sales have fallen. By what percentage? We can calculate that. Or what had happened? What would our numbers be like if we had in the prior had $5,000,000 sales? Well, easy calculation, 5 to 10 would tell us that our sales have doubled. So this is giving us some sense of growth or contraction over time. And the way that we calculate that is just the current year, whatever it is. So if we're in 2026 and we've got numbers for 2026, we would subtract from that our previous year's figures and then divide them by the previous year again. So in this case, it would be 2026 minus 2025 divided by 2025, and the result then again would be multiplied by 100 and expressed as a percentage. Okay, so in the case where we had $10 million in 2026 and $5 million in 2025, that would be 10 minus 5, so that's 5 divided by 5 and then multiplied by 100. And in that case, that would be 100% growth. Okay, and again, you can do this with any component of the financial statements of the balance sheet, any particular line item, so current assets, long-term assets or fixed assets, current liabilities, long-term liabilities, equity, or even any line item within those things. You could do vertical analysis or you could do horizontal analysis. So that's an introduction to what these things are. A little bit more detail. Again, with what we're trying to do here is to common size our financial statements. So we would express each item on the statements as it relates to the statement of financial position or the balance sheet as a percentage of total assets, or the statement of income as a percentage of total sales. So we're looking at our costs and expenses as a proportion of sales. So one of the components of the income statement is cost of goods sold. And we could ask ourselves, well, if we look at cost of goods sold, how big is that as a percentage or a proportion of our sales? And that's exactly what vertical analysis would give us. And you could look at any line item on either the income statement or the balance sheet and do the same calculation. So this starts to give us a sense if we're particularly efficient or maybe we're inefficient at generating profit, at why that's the case, at where for every dollar of sales our money is going and how we're retaining profit. And that also, because we're converting everything into percentages, it better enables us to compare. It better enables us to compare with other firms because we're looking at percentages as a base relative to 100 from one firm to another, and it provides a better basis of comparison. Okay? So for Brady Goat, what I'm going to suggest you do, hopefully you've got these statements in front of you or nearby, you could look at within the statement of income or the income statement, you could look at what's referred to as COGS or cost of goods sales. You could look at gross profit, and you could look at total operating expenses. Okay? You could also look at net profit. And look at that for the 2 years for which there is data and ask yourself, how do these figures compare across the 2 years? Okay, so again, cost of goods sold, gross profit, total operating expenses, and net profit, all relative to sales. So what you'll do is you'll get your financial statements, and lo and behold, there they are. So we're not really concerned at this point in the statement of financial position because the question is related to items that you will find on the statement of income. Okay, so I'll point out here that we've got cost of goods sold, that we've got operating expenses, and we've got a variety of operating expenses, but they're expressed as a total here. I think I asked you also for gross margin. Well, here it is. And then we've got net income. So you could look at those things all as a percentage of sales or revenues. So I'm not going to walk you through it as simply as this or as clearly as this every single time, but you'll see these are the line items that you would need in order to calculate these things. Okay, so simply stated, cost of goods sold relative to revenue or sales, gross profit relative to revenue or sales, same thing with total operating expenses, and same thing with net profit. So you would do that by looking at the statement of income. And I'll note again that you've got 2 years here. You've got figures for 2021 and for 2020. So you would do those calculations and then you would capture them perhaps in, so here 2021, 2020 for all the things that you needed to capture. Again, you don't have to use this template, but it enables you to keep things nice and neat. And that better enables you to participate in class, but more importantly, it enables you to answer these questions and for an examination, or maybe even more importantly than that, to do a comprehensive financial analysis toward a business case or in the real world. Okay? So that's how we would step through that stuff. Okay, so vertical analysis, once we've done this, is maybe we ask ourselves my favorite two-word question, so what? So we've done this calculation, what does it matter? Well, then we start to look, okay, well, how have these numbers changed over time? So if I've got gross profit, for example, as a percentage of sales of 15%, how did I do in the previous year? Is this gross profit as a percentage of sales going up or is it going down? And if it's going up, is that a good thing or is it a bad thing? And then likewise, if we have competitor information, how does this compare to industry competitors? Presumably, profit going up year over year is a good thing, and presumably if we're higher than our competitors, that would be a good thing as well. But then, sort of the bigger picture, so what? If it's gone up, if profit's gone up, why has it gone up? Is it something we can expect to persist, or is it sort of a one-time thing? And is there any remediation that we need to sort of undertake? So if profit's gone down, why is it going down? Is there something that we can do about this? If profit's gone up, is it something that will persist? And how do we ensure that it persists? So this is where these decisions start to become a driver of action. And so we actually utilize these business decisions towards something. So that's a little bit about vertical analysis. Let's look now at horizontal analysis. So again, horizontal analysis is different from vertical analysis because we're looking at percentage change from one period to another, okay? And we can do this again for the balance sheet, the statement of financial position, or for the statement of income. And fundamentally, the calculation is this. It's new minus old divided by old. So if we're looking at 2025 relative to 2024 figures there, we would look at the 2025 figures minus the 2024 figures, and again divided by the 2024. Don't divide new minus old divided by new. It has to be divided by the older of the two periods. Okay, typically that's a year. And again, what we're trying to do is assess change over time. Okay, and what this enables us to do is create a means of comparison with other firms. So for example, if we're measuring our sales, are our sales growing more rapidly than our competitors, or are our competitors outpacing us? And again, so what? What action can we take as a consequence of this? Okay? So the same thing here. For the company Brady Goat, you can conduct a horizontal analysis. So in other words, this is the year over year change, and do this for sales, for cost of goods sold, and for gross profit. Okay, so we'll do all those things. Same thing here. We're going to look at our statement of income and our statement of financial position. We may ask ourselves, okay, first of all, where do I find these things? Are they on the balance sheet? Or are they on the income statement? Okay, I'll note that sales can also be referred to in revenues, and you'll see if you look carefully here, I'm not going to point it out as clearly that that is the case here. It's not called sales, it's called revenues. But then how do we calculate this? Well, our 2 years are 2021 and 2020. So new would be 2021 minus old would be 2020, and then divided by old, then multiplied by 100 and expressed as a percentage. So what you're going to do is find those line items, sales, cost of goods sold, and gross profit, and do that calculation. And then again, you don't have to do this, but it would make sense if you would capture these things within a nice, neat spreadsheet. You can create one of these yourselves if you like, and that'll enable you to keep things nice and organized. I will point out, and perhaps this is obvious to some of you already, that for this particular calculation, where with vertical analysis you could do it in 2 separate years because you've got 2 years of data, because with horizontal analysis you're comparing a current and a prior year, or a more recent with a less recent year, you're only going to be able to calculate this once with this financial statement. So if you've got 2 years of financial statements, you're only going to be able to calculate horizontal analysis once. If you had 3 years of data, if you had, for example, 2021, 2020, and then 2019 over here, you would be able to calculate 2021 relative to 2020, and you'd be able to calculate 2020 relative to 2019. So you'd be able to have 2 sets of horizontal analysis. So for as many years of data as you have, if you subtract one from that number, so 2 years of data, subtract one is one, that's how many years of horizontal analysis you'll be able to calculate. Okay, so you calculate that, you capture it here, and then you've got your data. Again, by the way, just before we leave that, we could look at this in comparative terms if we have similar figures for prior years. Now, we would need more data to do that, but we'd also want to get a sense of how this lines up against competitors and how industry. So how our sales are growing, how our costs are changing, what's going on with our profit, what's going on with our financial structure as it relates to assets and liabilities, if we were looking at the balance sheet, all those sorts of things. So that, in a nutshell, is vertical and horizontal analysis. The next thing we're going to look at is financial ratio analysis. And so here we're looking at one number on the financial statements relative to another number in the financial statements. So again, we're trying to get some sense of relativity, and it's going to try and help us answer a particular question. And so what we're going to look at here is what are referred to as solvency ratios, short-term and long-term solvency ratios, and we're going to look at three different profitability ratios. Okay, so ratio analysis, broadly speaking, is where we are assessing a firm's financial condition and performance through calculations and interpretations of financial ratios. Okay, and these are these are developed from the firm's financial statements. Okay, and again, we've got liquidity and leverage ratios, which collectively we will refer to as solvency ratios. And we've got performance ratios, those are our profitability ratios. Activity ratios we're actually not going to cover in Business 112. This is something that you'll see when you get into financial accounting in your second year. Okay, not that difficult to capture. We're going to stick with these for the purposes of this course. So in all cases, what we want to know is, first of all, what is the purpose of this particular calculation? What is it that I'm trying to learn? Then mechanically, how do I complete the calculation? And then once I've got the calculation, how do I interpret it? Is a number of one good? Is it bad? What does it tell me about the firm's financial performance? And then having done the calculation, we can start to get a sense of relativity. Say, okay, well, how does this compare with prior years if I have that data? How does this line up against my competitors? If there's an industry benchmark or an average, how does it line up? How am I doing in relative terms? Okay, so it's in this way that we can actually get a pretty good sense of our performance, not just in absolute, but also in relative terms. Okay. Something else that should be here, in addition to these three things, is if there is a generally accepted standard, or so what's sometimes referred to as a rule of thumb, how does my calculation line up against that? Okay, so let's jump right in. So solvency ratios, first of all, measure the financial risk in a company, okay, in its ability to continue as a going concern. And short-term solvency ratios measure a firm's ability to meet immediate obligations. And the ratio we're going to use for that is known as the current ratio. Okay, so that's a short-term solvency ratio, and it measures a firm's ability to meet immediate obligations. Long-term solvency ratios measure the degree to which the firm's assets are financed by borrowing, by debt. Okay, so the degree to which the firm relies on borrowed funds in its operations. And the ratio we're going to use for that is the debt to equity ratio. Okay, so let's look at each of these in turn. So first of all, the short-term solvency, or the current ratio, there's other short-term solvency ratios, but we're going to stick with one. The current ratio measures a firm's ability to pay its short-term debts from its current assets. Okay, so an analogy here, I suppose, would be if you were to look at the bills that you've got coming in right now. So maybe you've got rent due in the next month, you've got a phone bill coming in, maybe you've got an electricity bill, things like that. So those things would be due within the next couple of months and certainly within the next year. And then if you looked at the money that you've got in the bank right now, and also money that you would anticipate is coming in the next couple of weeks, or I guess as it relates to the current assets within the next year. So maybe you've got a part-time job and you're anticipating a paycheck within the next couple of weeks. So you would be trying to, whether you've been deliberate about this before or not, have a sense of the money that you've got now and the money that you anticipate coming in the next short period of time, and how that lines up against the obligations that you've got in the next little while. And that's really what the current ratio is. It looks at the assets, the current assets, the assets that are easily convertible into cash or convertible to cash within the next year, for example, not necessarily easily. And we ask ourselves, okay, well, how do those compare against my debt, my obligations to pay my employees, for example, or to pay for the materials that I've purchased to put my goods together that I'm going to sell? How do those things work? And so, generally speaking, with the current ratio, the higher the ratio is, the I'm just going to jump back here. Sorry about that. The higher the ratio is, the better the firm's ability to say. So higher is a good thing here. And the rule of thumb, or the generally accepted standard, is we want to see a ratio where we have $2 of current assets for every dollar of current liabilities. So that's what we mean by a ratio of 2 to 1. Okay, that's long been the standard. So again, what we would do here, the calculation is current assets divided by current liabilities. We would find those numbers for any respective year for which there's data available and just divide one by the other. Okay? So again, I'll go to the financial statements here. You can ask yourselves, maybe have a look around, the balance sheet or the statement of financial position, and also the statement of income, and ask yourself, where do I find current assets? Where do I find current liabilities? So we'll have to see, and I'm going to leave that to you. You have a look around and see if you can find these things. They're fairly well marked, current assets and current liabilities, and make that calculation. And then once you've done that, again, we've got the current ratio, we've got multiple years, so you could do it for 2022 or 2021 or whatever years we've got, 21 and 20, I guess. I got that wrong. So 2020 and 2021. And then if you look, you'll see that maybe there's some information for industry averages, and maybe you're able to compare against what the industry average is. And then you could also record that as well against what the overall industry average is. We know that the generally accepted standard is 2 to 1. So how do the calculations that I've captured here, based on the information that was here, someplace, nobody knows yet, have a look, see if you can find it. How does it compare against both the generally accepted standard and any competitor information that we've got in the form of the industry standard? So we're capturing, all we're doing is organizing this information now, okay? And that's how we would calculate and then record the current ratio. Debt to equity is different. So if the current ratio measures our ability to serve or to pay our short-term obligations, the debt to equity ratio measures the degree to which the company, its assets, are financed or is financed, through borrowed funds that have to be repaid as opposed to equity. Okay? And the way that we calculate this is debt. And by debt, we mean total debt, not current liabilities only, not long-term liabilities only, but current debt. So that's current liabilities and long-term liabilities. So what we're going to look for is a line item that says total liabilities or total debt, and we're going to divide that by owner's equity. Okay? And that can be expressed as a percentage, or it can be expressed as a raw number. Okay, so we can either take that number, multiply it by 100 and express it as a percentage, whatever we get here, or we can just show it as a raw number. And any number greater than 100, okay, shows that a firm has more debt than equity. So that would mean the numerator was greater than the denominator, and consequently we would have a calculation larger than 1, okay? Higher is more risky from a lender standpoint. And the benchmark we're going to hold that we want to have a debt to equity ratio, generally speaking, of 1 or lower. But that benchmark varies an awful lot across industries based on the capital that's required and the nature of the business. So as you can imagine, the capital structure, the assets and the liabilities and the equity, the structure for example, an aircraft manufacturing firm that would require a lot of buildings and heavy equipment to manufacture their product, aircraft, would be very different than a management consulting firm where you might be able to rent the building that you work in and where most of your assets would be human capital. Okay? So again, here we go. We've got the statement of financial position or the balance sheet. We've got the statement of income or the income statement. And what you're going to need to find here is your total liabilities, not your total current liabilities or total long-term liabilities, but your total liabilities. And then you're going to divide that by equity. And sometimes it's called owner's equity. Sometimes it's called shareholders equity. Sometimes it's just called equity. Now, which statement are you going to find this on? Over here or over here? Nobody knows yet. That's up to you. You're going to have to find that yourself. Okay? And then once you've calculated, again, we're going to look and we're going to record this. And so we can do it for multiple years if we've got that sort of data. Then if we've got competitor data or industry data, we can record that. We can look at 1 year versus the other. Is it going up or down? And generally speaking, up is not a great thing here. It's not always terrible, but it's not a great thing. And our generally accepted standard, again, is we want to try and stay below 1 to 1. Okay? So this enables us just to organize our work. Okay? So that's the solvency analysis, yeah, for the short-term solvency, which is our current ratio, and long-term solvency, which is our debt to equity. The other thing we're going to calculate is profitability ratios. So this is the overall company profitability. And so potential investors are interested in this. The management team's interested in this because they might be compensated on the basis of profit, as you see here. And generally speaking, the higher, well, always, the higher the ratio, the more profitable the firm. And generally speaking, we are interested in more profit. And we're going to look at not one, not two, but three different measures of profit: return on sales, return on equity, and earnings per share. Okay? So let's look at those in turn. Okay? So first of all, return on sales measures how well the company generates income from sales. And so our ratio here is going to be net income, okay? Net income divided by sales or revenue or sales revenue, okay? So that's pretty simple. We've got net income, we're going to divide it by sales, and we would typically express this as a percentage. So we've multiplied this figure by 100, express it as a percentage, and generally speaking, well, not generally speaking, higher is better, okay? We want a higher return on sales. So you'll recall that I asked earlier if $1 million in profit was good. Well, if $1 million was earned in profit relative to $10 million in sales, okay, well, that's 1 in 10. That's profitability, or return on sales, in other words, of 10%. The other example I offered was if you had $1 million in net income relative to $1 billion in sales. Well, $1 million still isn't bad, but a million divided by a billion is only 1 in 1,000, so that's a considerably lower return on sales. So in the first example, $1 million generated out of only $10 million in sales, you would have a much higher return on sales. Okay? So that's one of our measures. And I'll note here that our numerator, our top number, is the net income. Just remember that, because when we go to another one of our measures, so return on equity, this is where we measure how much was earned for each dollar invested by the owners. That's the shareholders' equity, okay? So what you may not know yet is all the ratios that we've looked at so far: the current ratio, the debt to equity ratio, and return on sales. To this point, that we've been able to gather data from only one of the two financial statements, either the statement of financial position, the balance sheet, or the statement of income. In this particular one, we need to gather data both from the income statement, that's where your net income is, and your balance sheet. All that means is you've just got to look at both statements rather than one of them. Not particularly difficult. And I'll point out again that your numerator, your top number, again, is net income, the same as it was when we were looking at return on sales. But our denominator is different. It's owner's equity or simply or shareholders' equity. Okay? Numerator, denominator. Simple as that. And then finally, our final measure of profitability is earnings per share. And this measures profitability compared to the number of shares outstanding. And shares outstanding is a representation to how many shares are out there held by shareholders, held by the owners. Okay, and they would typically be rewarded in the form of dividends. The shareholders are the owners of the company. They have a vote on the matters of the affairs of the company, and so we want to have a sense of how many shares are outstanding. And again, this also requires data from both the income statement, that's the net income, and the balance sheet, the number of shares. Okay. So again, same numerator, net income divided by the number of common shares outstanding. Sorry, I'll just jump back to that. The number of common shares outstanding. Simple calculation. So I should have pointed out before when we looked at return on equity, that's expressed as a percentage, as is return on sales. So expressed as a percentage, expressed as a percentage. This is just expressed as a raw number. So if it's 1.21, it's $1.21 per share. It's expressed as per share. Okay? And so in order to calculate all these things, again, we would go back to our financial statements. We would find each of the figures that we're looking for, do the simple calculation, and probably record it on our master sheet. Okay? You don't have to do it this way, but it's good to stay organized. Okay, so once you've done this, we ask ourselves, well, so what? This is where we do the comparative analysis that we've been recording all this time. So if we've calculated profitability measured by return on sales this year of 10%, is that good? Well, if the prior year was 5%, then we've doubled our return on sales. That's probably good. If the prior year was 20% and now we're down to 10%, that's not so good. So we can compare relative to ourselves over time. Okay, are we more profitable or are we less profitable? But also, if there's a generally accepted standard, and that would be true for both of the liquidity ratios, then how do we line up against those? How do we line up against our nearest competitor? And how do we line up against the industry average? So then, if we have all that information to the extent that it's available, we're then better able to make an assessment of the firm's financial performance. So we can say, for example, using the simple example of return on sales of 10%, and I'm going to make up the comparative numbers, that not only do we have a return on sales of 10% this year in 2026, but that's better than our return on sales last year, okay, compared to 2025 when it was only 5%. There is no generally accepted standard, but we know that if we compare to our nearest competitor, that we're actually up there. Our nearest competitor only has a return on sales of, say, 7%, and the overall industry average is 8%. So in all cases, this is good news. Now, it could be the case, I just made up those numbers, it could be the case that our return on sales is lower than our nearest competitor and lower than the industry average. And in either case, we'd want to know what is it we're doing, what should we keep doing, and what changes should we make to improve our position in both absolute terms, in terms of how we're doing in absolute terms, but also relative to prior years and to our competitors. And it's in this way that this sort of financial analysis enables us to, at a more detailed level, start to make decisions that impact the business. Okay? So back to our financial statements. Again, what I would really encourage you to do is to make a habit of being organized, okay? This will, a lot of the biggest challenge in this work at this point is just familiarizing yourself with the overall structure of the financial statements and finding the data. Once you find the data, you've got numerators and denominators, and in one case, horizontal analysis, you actually have to do subtraction. But you've been doing subtraction and division and multiplication since you were kids. The math isn't difficult. It's just finding out where all this stuff is structurally in the statements and then capturing it in a way that you're able to quickly access it and then speak to it. And we're going to practice that when we're in class. But I wanted to take you through it with this video. I hope that it's been helpful. That's a summary. And any questions or concerns about this, I would really encourage you to, over the next couple of days, go through all this stuff and practice calculating all these ratios. And then when we meet again on Thursday, we'll have an opportunity to have a more robust conversation about what all this stuff is. I will go through all this stuff again, but we'll have a more robust conversation about the actual calculations themselves and what they all mean. And this is it's going to be helpful not just for the midterm exam, although it'll certainly be helpful for that, but also for your overall understanding of financial performance. That's all I've got for now. Hope you have a great day, and we'll see you later on in the week.